Welcome, everyone. As we're making our way in, I'll ask Adam to move to the next slide. We'll pause at this slide. It's information about United Church Funds. And as you're reading this, I want to let you know that our town hall will be in webinar mode. That means that you can see and hear only the presenters. We do this to minimize distractions and background noise and to provide you with the best experience possible. Want to let you know also that your questions are most welcome, and anytime during this webinar, open the Q&A box, type your question in, and at the end, we'll answer as many as we can. If time runs out, we'll reach out afterwards, or feel free to reach out to us anytime by email. We'll also mention that today's town hall is being recorded. The recording, as well as all slides, will be up on our website, probably as early as tomorrow. We know that many of you find these helpful to review and to share with others, such as your investment committees or your boards. I want to thank you for joining us at this United Church Funds Town Hall. I'm Charles Bach, President and CEO of United Church Funds, or UCF, and I hope that all of you are doing well in these hot, steamy summer months. You're finding ways of staying cool and being relaxed. On the next slide, we have up today, you'll see Stacy Pettis, our executive for institutional relationships, sharing organizational updates. She'll introduce two of our newest staff, Jason Gonzalez and Tiffany Willems, whom we're delighted to welcome to the UCF family, and they're with us today. We'll hear next from Matthew Illian, Director of Responsible Investing, who will share updates on our responsible investing activities. And then Matt Wagner, Vice President of Institutional Relationships, along with Stacy Pettis, will take us through the market and fund updates, and they'll be joined by our investment team from the pension boards UCC, Dave Klassen, Lodkai, Minotti Dhanaraj. Again, if you have questions, put them in the Q&A, and we will take them at the end. I want to mention before we move into our program that early this summer, UCF and all the UCC financial ministries were presenting sponsors of the UCC's General Synod in Indianapolis. If you've been to Synod, you know that a lot of things go on there, and you probably have been reading the stories and the summaries on the UCC and UCF websites. We're going to use our first poll question to share some of what happened at Synod, and this is, I want to ensure you, not a test of your knowledge in any way. It's more about informative fun and to get you involved. So take a look at this. If you can't see the whole screen, you might want to maximize it. I want you to select all the events that you think took place during Synod. I'll give you a hint. One of these did not happen. And the second hint is that the first one definitely did happen. So you should all check mark that. And that is that Karen Georgia Thompson was indeed elected General Minister and President. Karen George is the first woman head of the UCC. And as General Minister and President, she serves on our UCF board. So we welcome Karen Georgia as General Minister and President and to our United Church Funds Board of Directors. So I will tell you that the second one, Synod resolution calls for reducing single-use plastic, is also something that happened. This is one of a dozen plus resolutions that were passed by Synod delegates. Resolutions speak only for Synod delegates, and they are offered for serious consideration by local churches. And I want to tell you that UCF takes all of these resolutions seriously. And in fact, many of our investment policies are influenced or shaped by these resolutions. This particular resolution is in line with the UCC emphasis on environmental justice. It encourages churches to find alternatives to single-use plastics like water bottles, utensils, packaging, as well as to find ways of mitigating plastic pollution. Synod attendees donated blood and prepared over 3,000 menstrual hygiene period packs. A lot of things happen at Synod, and this did as well. Blood drives, mission projects like the period packs. Period packs were to highlight period poverty, the challenges that women and girls around the world face in obtaining feminine hygiene products. Wonderful program. The fourth one, this is the one that's not quite true. There were youth gathered at Synod, but it was a smaller number than previous synods. But still, they joined hundreds of Synod delegates who crossed the street to the state capitol to protest recent state laws in Indiana, such as one that bans gender-affirming care for minors. And then finally, the last one is true. Delegates voted synod frequency from every 2 years to every 3 years. So that means the next synod will be in 2 years, 2025 in Kansas City, but the one following will be in 2028 and every 3 years thereafter. A lot of this decision was driven by finances. Synods are very expensive. More and more conferences finding it very difficult to send delegates to synod. Well, thank you for participating in that poll. And before I turn it over to Stacy, I want to thank our marketing and communications team, Debbie Wibowo and Adam Sank, who work behind the scenes to make these town halls possible. Thank you so much, Debbie and Adam. And I am pleased now to introduce Stacy Pettis to bring organizational updates.
Thank you, Charles, and welcome everyone. I have the pleasure of sharing some of our organizational updates with you. The first half of 2023 has been very busy for UCF. Year to date, we've filed 11 shareholder resolutions on behalf of each of you as shareholders, in which you'll hear in greater detail about shortly. We also would like to formally welcome and introduce to you our new client services associates, Jason Gonzalez and Tiffany Williams. They will briefly introduce themselves now. Let's start with Jason.
Hi, everyone. My name is Jason Gonzalez. I was born and raised in Brooklyn, New York. Prior to coming to UCF, I completed my undergrad in Hunter College. I worked in the jewelry production and tech space startup field prior to coming to UCF. As some of you may know, Krista, who was working as a client services team, I was fortunate enough to be training with her when I first came on board with her back in February 2023. She was able to show me the ropes and kind of showed me the in and outs of UCF and how it operates, and I'm lucky to be here. With that, I'll pass that off to my colleague, Tiffany Williams.
Hello, everyone. My name is Tiffany Williams. I'm the newest member of the client services team. I'm born and raised in the Bronx, New York. Prior to coming to UCF, I was working in client services with a focus in finance for about 15 years now, and I look forward to working with all of you. Thank you.
Thank you both so much. We are so excited to have you as part of the UCF team and family. And I know our clients look forward to working with you as well. In that same vein, we are continuing to expand our staff to support the needs of our growing client base. We are actively seeking candidates for our institutional relationships team and client services team. And we'll be sure to update you with those announcements in the weeks and months ahead. In Q3 and Q4 of 2023, UCF will be embarking on an exciting journey to update our look and our brand as we continue to evolve and meet the ever-changing needs of our valued clients. We expect to launch this refresh branding in 2024, so be on the lookout for that. Also, we were proud sponsors of General Synod 34 held in Indianapolis last month, and also a primary sponsor for the Valerie Russell Luncheon with keynote speaker Brian Stevenson. Brian Stevenson is the founder and executive director of the Equal Justice Initiative and author of his memoir, Just Mercy, A Story of Justice and Redemption. We invite you now to listen to a short clip of his speech at the luncheon.
In addition to our identity, understand this concept of proximity. I talk about proximity a lot because I don't believe there's any way to do justice, any way to love mercy if you isolate yourself from people who are experiencing injustice. The only way we understand how to do justice is when we get close to people who are suffering and excluded, marginalized, incarcerated, and condemned. It's very easy in the United States to isolate yourself, to separate yourself, to find a place where people who look like you and talk like you and sound like you all congregate together. You can get to a place where you don't have to deal with homelessness. You can get to places where you don't have to see inequality and injustice. Nobody has to go to a prison that hasn't been convicted and sentenced. And that instinct to get distant is very common. But I believe that to do justice, I believe we are called to get close to those who are suffering, close to those who are excluded, close to those who are disfavored.
This message from Brian Stevenson was one of the most powerful speeches we have heard, and it was definitely the talk of General Synod. And his remarks about proximity are what we also look to do as we focus on responsible investing here at UCF. And so I invite you to also hear from our Director of Responsible Investing as he shares about the work that we are doing on the ground level, working to engage with corporations that we're shareholders of. So I'll hand it over to Matthew Ilian.
Thank you, Stacy, and good afternoon to you all, or morning, or wherever you are calling in from. We are, when we talk about practicing proximity, I think Brian Stevenson really challenged all of us. I know for UCF, it means we're active owners. We are not passively holding companies. To do our jobs well, it means we need to lean in. And as we lean in, we bring our faith values with us. And these are the values that guide UCF. I will say, as we do that, in particular, we're trying to do a better job of listening and responding to those who are most impacted by injustices in our capital markets. So this includes those who are most impacted by pollution, could be those who are most impacted by poverty wages. We've talked in the past about our work with the dollar stores, and unsafe working conditions. And so this is, part of us leaning in and doing that job as active shareholders. One challenge that we face, though, is on this next slide, you'll see a map of the United States. And it's an illustration of a conservative attack on ESG principles and ESG data. And it's closely aligned with those industries protecting fossil fuels and the weapons sectors in particular. It's orchestrated by right-wing groups, including the Heritage Foundation. Some of you might have heard of ALEC, but they're working with predominantly red states to bring legislation to in 37 states, so not all red states, in fact, some purple and some blue states. You see, New York's in there, to limit access to what they're calling woke investing or access to ESG. So an example in Texas is they've created a blacklist of investment companies and banks that Texas municipalities, governments, universities are not able to do business with. And it's caused a huge expense to the Texas taxpayer to limit access, but it's also impacted some of the big Wall Street firms and asset owner names. So you'll see on the next slide, even though I should be clear, the great majority of this legislation has failed. And so most legislators, most states are seeing through that these principles are not good for business, not good for competition. But, we've seen examples where companies like BlackRock, you can see, in the first headline that BlackRock is backtracking over climate commitments. Now, let's be straight. BlackRock, as the largest asset owner in the world, has never been a leader on climate anything. However, what we're talking about is this kind of battleground for the middle and helping move some of the largest asset owners to be publicly supportive, or in many cases silent, when they should be speaking out for, in response to a low carbon transition, in response to, investment and business risks that are involved when these things get ignored. Another Market Watch has had headline on Vanguard pulling out of this Net Zero Asset Owners Alliance. In response, our affiliation with ICCR, the Interfaith Center for Corporate Responsibility, is bringing both to legislators and to these large asset owners the fact that many investors like UCF and other faith and values-based investors, expect that any of these companies that we're in relationship with will continue to take into account environmental, social, and governance factors when they're doing their proxy voting, when they're doing their own corporate engagements. And so we are absolutely, with our partners, making sure our voices are also heard in this, this current sort of culture war that we're seeing. If you'll turn to the next slide, we've actually filed more shareholder resolutions than I think ever before. This year, we filed 11 shareholder resolutions. And you'll see in this infographic that Debbie Wibelow created, one of them received the majority vote. We'll talk about that. 3 were withdrawn because the corporations agreed to make reforms. And so we felt like we didn't need them to go to a vote. In 7 cases, UCF, we were the lead filer. In 4 cases, we were what's called a co-filer, meaning we were there lending our name and support with another organization that led as co-filer. The majority of those resolutions were in what we call the social bucket. You see Dollar Tree, Dollar General, HCA, Keysight, and Yum all had social aspects to those resolutions. We had 2 that were purely environmental focused at Goldman Sachs, Westlake, 2 that were governance focused at Alphabet, which is Google, and Meta, which is Facebook, and then 2 that had these intersecting frameworks at Citibank and Phillips 66. The average support we received across all the resolutions was 22.6%. So almost a quarter of shareholders supported the resolutions that went to a vote. If you go to the next slide, we'll highlight 4 that we believe, kind of really stood out. So the first at Dollar General, in this case, we were a co-filer, but we worked closely with a group of ICCR members to engage Dollar General on their health and safety record. They had a very poor track record. In fact, OSHA deemed them as a severe violator because of the great number of health and safety issues that were found at their stores. And we tried to engage with the company that they would understand how serious this issue was. They, they basically said, hey, we've got this under control. We've got it figured out. We said, no, you don't. We want to put it to a vote to the shareholders. And we got 68%. It was the highest support ever for a health and safety shareholder resolution. And so the company definitely has a mandate now to pay much closer attention to this shareholder vote at Dollar General. The 3 other noteworthy results at Keysight, HCA, and Phillips 66 were all withdrawals of shareholder resolutions. So they never went to a vote. And in fact, we often see the most progress when these don't go to a vote. The company will agree we'll have a signed commitment that they'll work on these issues. At Keysight, it was some of their technology was showing up in Russian weapons. And so we were asking for much better know your customer due diligence protocols and human rights policies. At HCA Healthcare, the issue was access to abortion and reproductive health care in states where restrictions became onerous. There was a lot of confusion. There was a lot of fear. Particularly this was focused on those seeking emergency reproductive health care, emergency abortions. The company agreed to put greater disclosures out that would help both patients and doctors know that they had protected rights. And at Phillips 66, that was special to us. We worked on this with our sister organization, the Pension Board, and they agreed to enhance their lobbying disclosure with particular attention to climate factors. And so we're very excited about all 4 of these. And additionally, on the next slide, it lists the results of all of the remaining resolutions. You will be able to get this report emailed to you after this, so you can dive in a little bit deeper. I will highlight that 3 at Alphabet, Westlake, and Meta, the first 3 have a percentage vote by overall shareholders. And you'll see, let's just say for Meta, it received 14.6% by shareholders. But we highlight that it received 39.2% of independent voters. So what accounts for that difference? Well, what accounts for it is that Mark Zuckerberg owns 13.4% of the company, but his 13.4% of the company, his special super shares have 10x the voting power of all the other shareholders. So essentially, he controls 62% of the vote. So the fact that we received in these cases 39.2% of the vote, that means a lot of the independent shareholders voted for and supported this shareholder resolution. If we'll go to the next slide, is our poll question. If we'll bring that up. One more poll question for you all, and this is, of all of UCF's values, which are most important to you and your organization? And multiple choice, so you can select several. Is it our relationship with and connection to the UCC? Is it our responsible investing work and corporate engagements? Is it our commitment? Oh, and I'll give extra points for anyone who answers number 2. But also number 3, equally important, our commitment to diversity, equity, and inclusion, DEI, our competitive market performance, and lastly, other. And you can, if you'd like, you can also add, if there's something else that we've omitted here, what it is that of our values and the work that we do that's most important to your organization. And with that, I'm going to pass the results, reading off the results, to my colleague, Matt Wagner, Vice President of Institutional Relationships.
Matthew, thanks so much. And thanks to all the participants for being with us tonight. Matthew, thanks for sharing all the good news and all the good work that we're doing on the sustainable and responsible investing front. Certainly at the core of what we do at United Church Funds, and really appreciate you sharing those positive results with our attendees tonight. As we can see here, I think most of the folks have participated in the poll. It looks like a majority of folks value our responsible investing work, our commitment to DEI, our competitive market performance, and also right at 50%, our relationship and connection with the UCC. So really appreciate everyone participating in that poll. And again, thanks to our technical team for providing those poll questions, and those will be part of our recording on a go-forward basis for further review. If we go to the next slide, we're going to switch gears and talk a little bit about the market performance for the first half of the year. And some of the themes you'll see here should be no surprise to many of you that watch markets and that have participated in meetings with Stacy and I doing portfolio reviews for you all. Clearly, we had a fairly significant market recovery in the first half of 2023 after a much more challenging 2022. S&P 500 up about 17%. The Russell 2000, that index that we look to for our small cap exposure, up about 8%. And our developed markets overseas up about 11.5% for the year. We're going to have a specific slide about all of these later, but we'll have a specific question around the fixed income slide because those markets have adjusted to this higher interest rate environment and look to be a little bit more attractive than perhaps they were clearly in 2022 as yields have risen and have given us some attractive valuation metrics as well. And then lastly, we'll share some information on international markets, what we're looking at there, and then also the importance that active managers and our investment managers in our portfolio play related to the managers that we choose and making sure that we're carefully monitoring them on a go-forward basis. We want to go to the next slide. We're going to look at some market results. You can see there the S&P 500 in the year-to-date column. That would be January through June. And for Q2 on the far left, you'll see a variety of these indexes that represent portions of the market where we may or may not be invested at any given time at UCF. But it gives you a feel for where market returns were. Clearly, equities again have had that nice bounce back. And if you look at the bottom right, you'll notice on the far right, year-to-date percentage increases for 2-year, 10-year, and 30-year treasuries. And you'll note that 30-year and 10-year essentially unchanged year-to-date. The 2-year treasury yield has moved up a little bit to about 4.9% as of the end of the second quarter. Next slide. This is a slide for many of you that participate in these every quarter. You've seen this slide before. A lot of data on this slide and a lot of numbers, but I'll draw your attention to a couple of time periods that we've isolated in that box that you see on the top. If you'll take a look in about the middle of that box, you'll see some metrics where we had a market peak in and around the 19th of February of 2020. Remember that the world looked a lot different. That was essentially sort of pre-pandemic shutdown. The S&P 500 was at about 3386. The 10-year treasury at about 1.6%. Fast forward to 6/30/2023, and we have a S&P index level at 4450, which represents about a 30% increase from that pre-pandemic level, with a 10-year treasury yield that has more than doubled to 3.8%. But the PE ratio of the S&P 500 remains essentially the same. Taking a look at the overall value or this metric that's really valuable to us, that essentially tells us how expensive the S&P 500 is on a relative basis. Interesting that we're sort of at the same level, yet the dynamics have changed very dramatically. Next slide. So with this slide, we'll note we have used this in portfolio reviews, and with this, I'm going to pose a question to Lan Kai from our investment team. And again, want to introduce our investment team, Lan Kai, Manothi Dhanaraj, and Dave Clausen. Thanks all three for being here. So we've had a couple of slides, Lan, that have talked about this nice bounce back in equities, and clearly after what was a more challenging environment in 2022. But we see here by this slide that return in 2023 has been really driven by a narrow segment of stocks, particularly these magnificent 7 mega caps. So the question is this: we mentioned this, we know this, we understand that this is a risk that we can keep an eye on, this sort of lack of diversification and return generation. Have you seen other bounce back periods like this after bear markets and sort of similar market characteristics? And how are we positioning our portfolio? Now, I will note to you, Lon, before you answer, that we do say in that bullet below that this is the highest concentration level that we've seen since 1932. I know that you weren't around then, but we'll talk about maybe some other markets that have looked similar to that in more recent years. Lon?
Yeah, thank you, Matt, and happy to be here. It's a fair question. I wasn't there in 1932. However, we did look at history over the last 100 years, where the leadership is as narrow as the current stage. Now, granted, the current state is very narrow, the narrowest ever since 1932. But there are about 65 episodes where the leaderships were quite narrow. And before 1990, those narrow leadership, on average, led to a market rally of 17% 12 months after such narrow leadership. And after 1990, the market that went up on average is about 9%. And there are episodes where such narrow leadership led to market downturn. In particular, 1930 was really very bad. It followed with 30% market drop. 1961 is another episode. And most recently is 2021, November 2021. So at this moment, what we wanted to see is the breadth of the market, whether small cap will follow. And we see some encouraging sign in July, month of July, Russell 2000, which is the small cap representation, went up 6%. It did better than S&P 500 or NASDAQ. And then the market turned negative slightly in August. Small cap did not underperform. More importantly, if you look at revenue growth and earning, the realization of the revenue growth and earning are quite healthy outside of tech plus sectors. So we are watching that very vigilantly at the moment.
Thanks, Lon. Really appreciate that response. And sounds like we've seen opportunities like this before, or seen markets like this before that have created opportunities, also potentially created some risks. So important that we have our active professional investment team monitoring our portfolio. I'm going to turn it over to Stacy for the next slide and question.
Great, thank you, Matt. In looking at this chart, I wanted to pose a question to Minothi Dhanaraj from our investments team. In looking at this chart, we see that history shows a shift to international equity outperformance following periods of U.S. market outperformance, similar to what we've seen over the last decade from 2009 to 2022. So my question is, how are our international managers expressing their optimism that this trend may repeat itself over the next couple of years, where international equity may start to outperform?
Thank you, Stacy. Thank you for the great question. So as everyone can see on this chart, a little over 14 years, historically, the US has outperformed international markets. But if you see about 8 years prior to that, the international markets outperformed, and that's on a cumulative basis. But if we were to dig deeper and really look at distinct calendar years, over that time period, international markets actually outperformed 41% of the time, and emerging markets actually outperformed 48% of the time. So it's very important to be diversified across international, developed, US, and emerging markets. Recently, we also spoke to all three of our international managers. Our international value manager truly believes that they're positioning at significant discounts and in high quality investments will do well over the long term. Our international growth manager has been very consistent with their process and strong long-term conviction. And they're also taking some opportunities right now in the short term. And then our emerging markets manager shared that they believe that given that the GDP growth is likely to widen between the emerging markets versus developed markets, there's going to be more favorable demographics in emerging markets and the fundamentals, as well as potential for the dollar weakening. Emerging markets should be more favorable going forward. So I'll pass it back to you, Stacy.
Thank you so much for that response. I'll hand it over to Matt to ask the next question.
Yeah, sure. Thanks, Stace. And thanks, Minothi, as well for that. You know, it's important for our investors to know, particularly in our balanced options, that we have exposure to international markets. We have the exposure to developed markets and also emerging markets for the exact reason that you mentioned. It's that, you know, it might not always be super crystal clear. It might not get all the headlines, but international markets are an important part of a diversified portfolio. And, you know, as we look at those charts and as we hear what our managers have to say, that diversification will hopefully be an important part of future returns. So thanks for that. My next question is for Dave Clausen. We've got 2 slides here, and I have 2 questions for Dave. Again, grateful for our team being here. After a long period of time where fixed income valuations were not particularly attractive, we find ourselves in a market environment where fixed income is again a very meaningful portion of a balanced strategy, as we just talked about with equities and US versus international. This particular chart shows us current valuation in a 10-year range and with a 10-year median. So for the viewers of this slide, take a look at where that diamond is. That's the sort of the current yield the worst across various fixed income sectors. And you can see that those yields are more attractive. So two-part question, Dave. First part on fixed income, maybe just very quickly, thinking back 3 or 4 years ago, how are we thinking differently about fixed income today as a portion of a diversified strategy? And might we see, the potential for us to even add to fixed income, say maybe in the next 12 to 18 months if this trend continues with these valuations?
Well, thanks, Matt. And certainly the environment is a lot different than it was three years ago, and even 10 years ago in terms of the starting yield in fixed income. And you can see on the left side of the page, the starting yield in U.S. Treasuries, is around the 4.4%, range. If you factor in the corporate market, it's closer to 5. So your starting point and your margin for error is a lot more productive than it has been. And fixed income can provide an important hedge. We are more constructive than at any time that we've been over the last 12 years, particularly if the economy does indeed start to slow.
Absolutely. I know we've had a lot of questions, and this slide is important. We've had a lot of questions from our investors in the last year or 18 months about where we stand as it relates to fixed income, where we stand as it relates to even adding cash to the portfolio, which is paying a very attractive yield and as part of our balance strategy. So appreciate that answer. If we flip to the next slide, our final question for the investment team tonight. So this is a chart that shows various asset classes. You can see on the left, large cap blend, mid cap blend, all the way over to some bond sectors on the far right. And this is the growth of $1,000 over the last 20 years if it were invested with a top decile manager and a bottom decile manager. So my question for Dave, rather than kind of going into the weeds on all the managers that we use, we do a lot of due diligence with managers. You and your team and Matthew Illian sits in on a lot of those meetings, talks with managers on a regular basis. So my question for you is this: if you can narrow it down sort of beyond performance, what are 1 or 2 hallmarks of well-run investment management firms that we look for when adding them to our portfolio?
Well, thanks, Matt. You're right. An enormous amount of time is spent, as you heard from Minothi and Lon, interviewing managers and getting underneath the hood of strategies. I would answer your question succinctly because I think that's what you want. Performance, I would just, echo that a little bit. Performance over a market cycle. And remember, over the last 10 years, we've had a weird cycle with low interest rates, and then we had the pandemic. So I think managers now are really showing their mettle. But it's performance through a market cycle. And I just add 2 more criteria, process and people. And people, they talk about process all the time. I think one of the worst things that we can hear is that our process is either deviated or it stayed the same for the last 40 years. I think the world has changed a little bit, so the process and the ways in which you're gathering data has to be modern and utilizing modern tools. I see a question about AI here, which we can address, but it's the ability of the process to adapt over a period of time. And then I think you've also heard us focus on the people at an investment management company. And I've always believed intrinsically that diversity is better. Diversity of thought and opinion, particularly if you can get different experiences and curiosity amongst the team. And I think UCF, United Church Funds, and the UCC financial ministries in general have taken diversity to the next level, really establishing the primacy of diversity and the belief in diversity in an organization. And the final point related to that is the ability of a firm to withstand turnover, because invariably people move on, but it's the ability of a firm to endure. The last thing we want to do is have to fire a firm because somebody is leaving.
No, absolutely. Dave, thanks for that. I think those qualitative factors that we look for in that are sort of bubbling under the surface, but exceptionally important when we think about the managers that we have on our platform, as well as adding new managers. I know that's a part, and I know the attendees on this call appreciate hearing a little bit more about that. I would remind the attendees that we do have a Q&A box at the bottom of the screen if you'd like to ask questions. As you're putting in, hopefully, some more Q&A. It looks like we have about 5 or 7 minutes or so before we'll wrap this call up, but we did have a question on AI. So I will throw this back to I don't know who from the investments team wants to take this, but the question is this: how is this going to impact the investment industry? Certainly we saw AI specifically, and I think maybe the sort of the hopes or aspirations about AI changing capital markets and changing landscapes drove that magnificent 7 slide that we saw before with all of those tech companies, drove up the, some of the expectations on how they're going to use AI. So how would we look at that as it relates to the investment landscape or the investment industry specifically, and how AI is changing our business?
Well, I think, Lon, you look like you wanted to answer, but I'll start, and then you can take the baton a little bit. And obviously, this has been a question that everybody is asking. I turn on Bloomberg, and they want to know how AI is going to influence the Magnificent Seven that Lon, alluded to in particular. And those are the headline stocks, the stocks that are perhaps growing a business or have some exposure to AI intelligence to begin with. But I think the deeper impacts, will be felt through the companies that are utilizing the tools to become more productive over time, and that's a longer term story.
Lon, did you want to jump in? I want to make sure that you have a chance to respond as well.
Well, yeah, absolutely, Dave. In a way that we look at the impact on the productivity side, that is pretty much the most important story for AI. The AI excitement, as you can see from the Magnificent Seven, will probably continue. And then when we have conversations with our managers, again, we rely on managers to be very thoughtful in finding the right impact names from AI, whether it's a cloud or chips or and then to differentiate what is hype, what is expectation, and what is speculation. And so in terms of the investment process, AI hasn't impacted our investment process. So we're still finding the best manager, as Dave just mentioned, and then have them to stay vigilant with the market and find the right investment opportunities. But AI would provide productivity improvement and automation in the future that will help the investment cases.
Thank you, Lon. Appreciate that. Another question here, and sort of a two-parter here. We're going to reach out with Ann McQuirkendale's question, our friend from Iowa, and then sort of do a follow-on with Steve Hotchkiss, our friend from Cleveland. So Ann has a question about asset allocation changes in the balanced fund. So let's talk a little bit about how we've tilted that fund over the course of the year. Maybe some changes, maybe slight changes in the asset allocation strategy. And then Steve's question is a part of that, which can be a follow-on, which is we use emerging market equities in the balanced strategy. He has a question about higher interest rates and impacting emerging markets. So maybe just talk about that as a follow-on to how we're positioning emerging markets in that diversified strategy of the UCF Balanced Fund.
Again, any one of us can take these. I'll get started. In terms of asset allocation, I think that we, and in particular, and others, that in balanced funds, we deployed some cash into fixed income in the October time period. I think it was October 24th, Lon. But still, we're holding a bit of cash. And then recently we narrowed, we took a bit of a slice off of equities after the big run and put it back into fixed income, but we still have about a 2.5%, 2% overweight in equities, and a bit of an underweight in fixed income, but we're getting close to redeploying a bit more as the economy slows. So I think we've been fairly good at hanging in there, not getting spooked by the equity market, staying at target or slightly above, and flowing money into the fixed income market as it makes sense. And Lon, maybe you want to just elaborate on the most recent decision to take a little bit of money out of equities and back into the fixed income market.
Right. Yeah. So I think UCF's balance fund, whether it's a UCF balance fund beyond fossil fuel balance fund and an alternative balance fund all benefit from slight overweight in equity coming into this year. And as market gets a bit extended, we decided to trim the equity somewhat. And then Dave just mentioned how attractive the fixed income opportunity is now on the absolute basis and on the relative basis. Therefore, we moved the money into the fixed income.
Thank you both for that. And we did have a question, and I think this was part of what I mentioned in a question about, perhaps waiting 12 to 18 months. We're certainly not waiting to deploy money into fixed income. As you've heard, we did that in Q3 or Q4, I guess, of 2022, and then again this year as well. So we certainly think that strategically fixed income valuations now are attractive, and again, trimming equity to add to those positions. Last question for this town hall comes from Arthur Clement, a friend down in Atlanta. With an inverted yield curve, are we anticipating a recession and slowing economy that will affect the stock market in 2024? I know you just mentioned that we're trimming equity a little bit with a potential economic slowdown perhaps in the offing, but any more that you'd like to share on that, investments team?
Oh gosh, a tough one. We sort of spent the whole first part of the year and the end of last year, kind of worrying about this recession, and then the market and the economy, surprised on the, on the upside. And I guess consensus is that the fourth quarter and the first quarter of the year still could be a little bit difficult. But I guess most important will be the profitability, which still stays fairly strong. So maybe one of the other members of the team can add to this a little bit. But I think one of our adages is we're less worried when everybody else is worried because it's reflected in the prices, and more worried when nobody's worried. So to the degree to which nobody is worried about the robust U.S. economy, and the cover of The Economist magazine signals that the U.S. economy will never go into recession, or it's the great growth engine, causes us to be a little bit more skeptical. So I know I'm throwing a lot of different concepts in there, but we tend to try to zig a little bit when the consensus is zagging. And I think my conclusion there is that now that people are less worried, perhaps we're a little bit more worried about the beginning of next year. So team, add on in terms of what I may have missed there.
I think that was a fairly comprehensive answer to a very difficult question, which is where do markets go from here in a very challenging environment with a lot of moving parts. So appreciate that answer, Dave. Thanks. And I want to thank the investments team, Dave and Manothi and Lon, all for joining us, as well as my colleagues on the call, Stacy and Matthew and Charles. Thank you for being here, Adam and Debbie behind the scenes, as well as Tiffany and Jason. It was a full house tonight for us. Very grateful that you were able to join us. We thank you, as always, for the opportunity to be of service to your church or organization. We're always grateful for your referrals, and we're also grateful for your questions. So as you have questions after this town hall, feel free to reach out to us, and we'll do our best to get back with you just as soon as we can. Thank you so much, and have a great evening.